So let's get started with things. Just as a quick disclaimer, obviously everything that we share in this Fusion Week Ahead webinar, you shouldn't take this as financial advice. Obviously, everything we share here is purely just for analysis purposes, for research purposes. None of what we share is any solicitation to trade anything. This is literally just my opinion on the markets, and you are best to take it as such. So I think let's start with precious metals. I'm sure there is a ton of questions about precious metals right now. What on earth happened to precious metals on Friday? It was an unprecedented move, obviously, that we saw to the downside for both gold as well as silver. Now, there's a couple of things to talk about here when it comes to the precious metal move. Loads of questions on this coming in over the weekend on my side, and it does make sense. You don't often see something like silver, pushing down over 30% in one session. It was a move of epic proportions, but I am similarly quite surprised by the amount of surprise out there when it comes to this move. We've been talking about the risk of these parabolic moves for quite some time. If you just quickly pull up a chart of silver, and let's go to the weekly time frame here, if you put these things into perspective, we are not talking about a crypto coin here. This was silver that went absolutely parabolic, right? And what we've been talking about over the past couple of weeks is that whenever you see these types of moves go parabolic, we all know that they end the same way, right? They end with nasty, eye-watering, painful pullbacks, mean reversion moves that kick in that might have nothing to do with the underlying fundamental view of the asset. It is because at some stage, whenever these moves go parabolic, it ceases to be a fundamental move and momentum and frenzy takes over. And the challenge that we have as traders is we all know how these moves end. We know that something goes parabolic will eventually end with a massive whiplash to the downside. These things that's how these markets trade, right? That's how these moves end. The challenge for us as traders always comes down to the timing, right? We knew this was going to happen, but we never know exactly when it's going to happen. The one thing that's always important, and this is why we've been flagging it so much recently, is implied volatility should never be disregarded when we look at markets like this. If we quickly go to implied volatility here for a second, I want to show you guys just the silver chart once again. Let's go to a 2-year view here and let's take silver. Silver implied volatility was trading at 91% going into Friday. Now you can see that even implied volatility goes parabolic. Now, the risk that we have when the markets get this crazy is that it opens up massive amounts of directional risk, both up and down for that asset. And that is where the risk lies with these moves, is that when these things unwind, it tends to be aggressive, it tends to be ugly. And that's really what we saw with silver. Just to put that into context for you guys, let me show you what a one-day implied volatility move looks like. So this is silver. Let's just quickly add in implied volatility. Now, this is looking at a potential one-day move, right? So that is just your one-day move. And that is about a 12% move, either up or down. That is the options market telling us, hey, with implied volatility at 90, we reckon there's a high probability that price can trade anything from 12% either up or down in any particular session. So if you extrapolate that out to a weekly range, a 34% move from the high to the low, that's about what we got. Now, that is what the options market said we might get with a very high probability on a 1-week basis. That was your 1-week range. So that is why we've been flagging these things, is that, when things get this crazy, everybody is now surprised. Everybody is blaming the Kevin Walsh news that we had being the next Fed chair as the reason why precious metals push lower. I think that is just lazy reporting work from a lot of financial media out there. The move in precious metals started way before we had the Walsh news. Now, could that have added to some of the weakness that we saw? Yes, I'm sure it did. But at the same time, we didn't see nearly as big moves in the likes of equities or the bond market or FX. So I don't think Kevin Walsh is to blame here. I think that is laying the blame on the wrong reason. Yeah, I think it is all to do with implied volatility. Now, obviously, the question that we've got, there's a ton of them already streaming in. Where to next for silver and gold? Look, let's take a look at a recent example, right? Let's go to gold and let's go back to 2020 was a good one. That was the last time we had this type of frenzy. Nothing close to this, but it was a similar type of price structure that we had. So I don't know how many of you traded back here, but same story, right? Gold went up and then it just absolutely went parabolic. So many people got completely wiped out because they tried to call the top in gold so many times, right? And the same thing happened this time when liquidity dries up at the highs, meaning when there's no more people left to take the opposite side of the trade, right? When no more people have money left to try and call the top, liquidity dries up and we normally get those air pockets to the downside. That's exactly what happened to gold. So very similar situation to what we have now is what we saw back in 2020, what we saw back in 2011. These moves all end the same way. Now, what could we take from this in terms of where we are now? We have to ask ourselves the question, right? Has the fundamental reason for why these things have been moving, have that changed? Personally, I don't think they have changed. Central banks are still rotating into gold, obviously diversifying out of the US dollar. You still have retail flow looking very, very strong in terms of demand for ETF holdings for gold. You still have a lot of geopolitical uncertainty in the mix. Obviously, from an options market point of view, things will definitely just even out on the risk reversal side. But bottom line is the reason why markets like these or why participants have liked things like precious metals haven't gone away. The thing that we have to be careful is that back in 2020, the reasons why people like gold didn't change either. Back in 2011, the reason why people like gold didn't change either. But in every case, we had that big flush to the downside. We saw a massive dead cat bounce, and then gold started to trend lower. Now, again, I'm not saying that, yes, this is exactly how things are going to happen this time around. But once markets have these types of flush out moves and the players that really want to be trading this get scared, you have to take that risk into account. So yes, the fundamental story hasn't changed, but if you had to put a gun against my head, and a disclaimer here, when volatility is this high in any market, I lose interest to trade it because your risk to way is just too great. The amount of you have to scale down so much on your position sizing to make the risk make sense. It just doesn't make sense in my mind, right? But if you absolutely had to trade this, my bias for this from a pure sentiment and price action point of view remains tilted to the downside. I don't think fundamentally anything has changed, but I do think that the type of flush out that we saw on Friday is going to make a lot of bulls think twice about getting back in. And again, if we were to see that slow grind, dead cat bounce back to the upside, remember that playbook from 2020, 2011. I do think that once you have these types of disorderly moves playing out, it makes it a lot easier for players to push markets higher, get a lot of bag holders, and then slam the thing back down to the downside. So fundamentally, I don't think anything has changed, but I do think structurally, from a flow dynamics point of view, the bias remains tilted lower. Again, that doesn't mean we can't have a dead cat bounce in this market, but I would be very careful on trying to get too clever with these things. The volatility is just too high, guys. Think about where you would need to place your stop to make sense of the risk, right? It's just too crazy for me. It's very, very lively. But that's just a couple of thoughts. If you have any questions on that, then obviously please don't hesitate to let me know. In terms of main events, I want to talk about the Reserve Bank of Australia coming up first. I think the RBA is going to be a very, very important decision for us this week for a couple of reasons. Look, if you take a look at what happened to the Aussie dollar over the course of the last few weeks, let's just go there. The Aussie has been on an absolute tear. If you look at the Aussie at the index level, we bottomed out obviously last year in April, and more recently going into the end of the year, we've just seen a big shot to the upside in the Aussie dollar. And the main reason for that comes down to the data, right? In terms of the economic data, things have been very solid when it comes to Australia, right? If you take a look at the first challenge was inflation. When inflation jolted up, the markets went like, this isn't good news for the RBA. The RBA even shifted their language more hawkish back in December, saying that, hey, if these types of things continue, we would need to consider this in terms of policy adjustments. Inflation is ripping to the upside. Growth isn't amazing, but it hasn't really done that bad, right? It's not looking anything close to what we saw back in 2021, but growth hasn't really been that bad. It's been okay. And if you take a look at the unemployment rate is pushed down to 4.1. We've had some recent very good labor data. So if you consider all of these things, it makes sense why the Aussie dollar has ripped. And as a result of these good economic data, the markets are now very confident that the RBA will be pulling the trigger on a hike for this week, right? We can see that probability for a hike this week is sitting at 74%. And we can also see that the markets are comfortably fully pricing in 2 hikes by the end of the year for the RBA. So that is where we are. Now, the challenge that I think we have for the Aussie dollar coming into this week is we have to ask the question of how much good news is already priced in. And if you consider the fact that a hike is almost fully priced in for this week, 2 hikes fully priced in by the end of the year, and if we consider that massive rush we've had to the upside for the Aussie dollar, I do think that a lot of the expectations that we have right now is already baked into the price, right? And I do think there are reasons to be cautious in terms of expecting a hike this week. I do think that maybe there's enough effort from these guys to pull through. But if you've been watching the RBA for as long as I've been watching the RBA, you will know that, okay, we've got some risks we need to consider here. Let's quickly go back to the first one that I want to talk about, and that is the jobs data. Right, so this was the first trigger that saw the markets, okay, this got us up to like 55% probability of a hike. Was it solid data? Absolutely. I mean, we printed 65K on the headline. We had 54,000 of that was full-time employment. We had the unemployment rate drifting down to 4.1%. That was really, really solid data. But there's a couple of caveats we need to discuss here, right? Even though the full-time jobs number came in at 54,000, the prior was 56, meaning that on a 2-month basis, full-time jobs actually contracted in the months November and December. Now, if you take it as a full quarter, we were still up 50K full-time, but that number there means that it's not just going to be an easy thing for the RBA to look at and say, oh yeah, that was really good, we should hike rates. That is a bit of a caveat we need to understand. Secondly, unemployment down to 4.1, that was undoubtedly very good, but a lot of the downside we had in the unemployment came on the back of participation, right? Participation dropped, and why does that influence the unemployment rate? If less people are looking for work, then it's easier to fill the jobs that is currently being looked for. So yes, it was good data, but by no means is that like a yes, we need to suddenly start hiking rates. The other thing we need to consider about that quarterly CPI data we had last week, was it hot? Yes. Undoubtedly hot across the board. We had the trimmed mean quarterly number. Now, that is the one that the RBA, that's the one they use to adjust policy with, right? That is their main trigger that they use. That printed at 3.4%, up from the prior 3.1. The RBA's own expectation of this was 3.2%. So are we higher than what the RBA estimated? Yes, but we are only higher by 0.2%. Right. So yes, we have seen it push up, but it wasn't a mammoth beat across the board, something that the RBA will, they won't be quaking in their boots on the back of that. And the other thing to consider, which I think is less of a concern for them, but also something to consider, is the fact that the Aussie dollar has been appreciating quite a lot. If you take a look at this from a real, the RBA basis, which is basically your inflation adjusted currency rate, we are trading back to prior cycle highs for the Aussie dollar, right? So we have seen quite a lot of strength playing out for the Aussie, and that in itself should be enough to mitigate some of the inflation risk that we have. But apart from all of these things, I think the one thing that is making me cautious about a hike this week is the language that we had from the RBA recently. The last time that we heard from them was back on we had some comments coming out from Hauser on the 8th of January. Before that, we had December comments. And if you take a look at the December comments, there's a couple of important caveats here. They were already expecting the Q4 CPI data to exceed their expectations. October's CPI indicates potential for Q4 inflation to exceed projections. That was already on the cards for them. Despite the fact that they already saw that happening, they said that it was premature to determine whether the inflation increase that they're seeing right now will be long-term or short-term, meaning that we need more time. They even say that they require more time to estimate whether this thing really is going to go crazy or not. They need more time. Apart from that, and this is the important one, they said that maintaining the cash rate at its current level for an extended period of time may be enough to stabilize the economy. That for me is very important, right? That does not sound like a bank that is going to just go guns blazing, hiking rates because we had one CPI print coming in better than expected. So I think the language itself warrants us just to be a little bit cautious of the possibility that maybe these guys don't hike rates this week, right? We need to be ready for that. Everybody jumped on the bandwagon. They're saying, okay, yeah, they hike rates. And you know what? Maybe they do hike rates. I just think that the risk of a hold is a non-trivial one at this stage, and that could be massive in terms of how it plays out for the Aussie dollar this week. Remember, from a trader point of view, we don't want to be right about where these things go. We just want to do our homework, build a scenario plan for ourselves so that if we do get that surprise, we are not sitting there with our hands folded saying, oh boy, okay, everybody expected a hike. What do I do now? You want to be prepared, right? You want to strike where the iron is hot. When you see that decision coming in and boom, it's a hold, you don't want to, contemplate what you want to do. You want to have your strategy ready so that, okay, this is something that was a potential risk. This is how I'm going to play this thing now. Then you just execute, right? You don't want to sit there and think about what you're going to do. The other thing that we need to quickly talk about when it comes to the RBA is that unlike a bank like the Federal Reserve, they want to make sure the markets are prepared, the Fed, right? If the markets are pricing in a cut or a hike, they normally follow through with that because they don't want a surprise. When it comes to the RBA, these guys just do not care, right? Back in just 6 months ago, back in July, I don't know how many of you can recall this, but back in July, the markets were 84% priced for a cut by the RBA. And they decided to hold rates steady, right? They cut the next month. They ended up cutting in August, but July was a massive upset last year. And now all of a sudden, everybody's like, oh, these guys have to hike rates. Everybody's expecting them to hike rates. There's a non-trivial risk that they actually decide not to do that. So I see there's three potential scenarios playing out. The first one is in line with market expectations, which will be a hawkish hike. What do we mean by that? It means they hike rates by 25 basis points, but they also give us a clear bias that more hikes are coming to try and curb inflation. Now, that I think is the best case scenario for seeing some extended upside in the Aussie. Now, there's a couple of pairs we can look at if we were to see that type of outcome. I think the ones that are quite attractive or interesting right now, the first one is the Aussie CAD. From a trending point of view, momentum has been very solid and very bullish on this pair for a while. The fundamental bias for the Canadian economy is a lot more bleak compared to that of Australia. And obviously, you've got a little bit of central bank divergence playing out between these two as well. Momentum is looking solid. And apart from that, if you take a look at what the retail crowd has been doing recently, take a look at where they are. They are exceptionally short this pair. Now, remember, when it comes to retail positioning, we always want to try and look at the opposite side of this, right? Because we know retail 85 to 90% of the time, they always try to pick a top or a bottom too quick. So whenever these guys are aggressively short, you want to favor things like longs. If these guys are aggressively long, you want to favor things like short. So the fact that they are short this pair by quite a big margin is already something that points to potential upside risk for the pair. So if we were to see a hawkish hike from the bank, Aussie CAD upside could be something worth keeping on the radar for the week. In terms of possible levels, look, I think that overhead resistance around the 95.50 has proven recently that the markets don't really like the pair up there. So I think if we manage to push up there, that'll be anything between 95.50 and 96 would be key areas to consider for some potential profit taking if we do see a nice run to the upside on the back of a hawkish hike. The other one we can consider as well is the pound Aussie. For the pound Aussie, the one thing that is a bit of a riskier is we've got the the Bank of England decision coming up as well later in the week. That is one of the potential risks. And the other thing that I'm a little bit cautious of here is implied volatility when it comes to the pound Aussie. Vol has gotten pretty crazy. Let me show you guys what I mean by that. So if we just quickly go to the pound Aussie here for a second. So you can see that vol has gotten very close to that 2 standard deviation band. Now, there's no rule to say that once that happens, price has to mean revert. But on average, whenever you get vol freaking out and then calming down, that normally has the inverse reaction to the pair, right? So the pair pushed lower on a higher vol. If vol starts to roll over, baseline expectation would be to see a bit of mean reversion in the pair. So that's not enough for me to want to be, not to want to trade the pound Aussie, but it's just a risk we need to watch for that if you were to look for some potential shorting opportunities. In terms of levels to watch, I mean, we've broken through so many key levels recently. I think key support around that 196 is obviously key. That's the lows going back the early part of Jan. Below that, though, if we do manage to take out recent lows, there's not a lot stopping us from a support point of view all the way back down towards 192. Again, the Bank of England, which we'll touch on in a second, is a risk we need to watch, but that is something worth keeping on the radar. Now, what about the other scenarios? The first one we discussed obviously was a hawkish hike. The other one is a potential neutral hike, right? So they hike rates in line with market expectations, but they make absolutely no commitment to hike again. And that, I think, could set up a very classic, what we call buy the rumor, sell the fact reaction, where everybody has been buying the Aussie in anticipation of this hike. If we then get the hike, but they don't convince the markets that the additional hikes that they've already priced in is going to happen, that could see a nasty short-term unwind in the Aussie dollar. Now, how can we look to potentially trade that? The one pair that I'm keeping on the radar here for the week is the Aussie Kiwi. The only other currency or country right now that is looking as hawkish on the rates pricing side compared to Australia is New Zealand, right? The markets have seen the recent data looking pretty solid. They're anticipating hikes for the bank towards the end of the year. I mean, let me just put that into perspective for you guys. If you look at the RBNZ, you can see that also 2 hikes fully priced by the end of the year. Now, they're expected to start a little bit later in the year, but in terms of the overall market expectation, there's an upward drift there on the curve basis. So the markets do think these guys hike rates this year as well. So I quite like the idea of some potential downside for the Aussie Kiwi if we do get a neutral hike, so they hike rates, but they give no inclination of hiking again, right? If the hike rate saying, listen, we've done this as like an insurance-based hike, making sure that we get in front of any potential upside scare in inflation. But this isn't us saying that we are going to start a hiking cycle. We are taking things one meeting at a time. We're being very patient. We're looking at the incoming data. That could see that, like we said, buy the rumors, sell the fact reaction to the downside in the Aussie. Now, the best case scenario then, obviously, for a trade this week would be if these guys don't hike rates at all, right? If they do a hawkish hold, meaning that they hold rates, but they leave the door open for hikes potentially later in the year, that could see some immediate downside in the Aussie dollar. That would no doubt be the biggest volatile surprise for the markets, and the Aussie, in my opinion, could be a massive flush to the downside. Not just because it's going to be a big surprise versus market expectations, but also from a positioning point of view. The markets have gotten incredibly long the Aussie dollar recently. I mean, if you take a look at how institutional positioning for the Aussie, let me just show you guys. I mean, take a look at this. They've just absolutely ripped to the upside. And again, if you compare those two currencies again, the Aussie dollar, which right now is bullish crowded, if you compare that to the Kiwi dollar, the markets are still fairly bearishly positioned for that. So you have the biggest upset potential for the Aussie Kiwi if we were to see them coming out with a hold. So that's definitely one of the biggest risks, guys, we need to watch for the week ahead. And again, like I said, even if they do follow through with a hike, there's always the chance that we see that buy the rumor, sell the fact reaction. If they cannot convince the markets with their language that they are hawkish enough compared to what is already priced in across the curve, that opens up downside risk for the Aussie that we need to consider. Right. So next up, the other thing that I quickly want to talk about is the Bank of England policy decision coming up on Thursday. Now, the markets aren't expecting a lot from this one, and to be fair, the recent data has been a little bit mixed, and we'll touch on that in a second. Let's quickly take a look at expectations here. We can see that the markets are pricing in 97% probability of a hold. That seems about right. Now, towards the end of the year, we can see that the markets are only fully pricing in one cut for the Bank of England. Now, let me first go to the data and show you guys why the markets are not really sure whether we're going to get 1 or 2 cuts this year. The recent data has been good on the short side, on the short-term data that we've had. PMIs have come in much better than expected. Retail sales have come in much better than expected. We can see that reflected in the City Economic Surprise Index, which has pushed up quite a lot recently. Now, apart from that, the other drivers, the main economic drivers that the bank will be watching has not been that sexy at all, right? Inflation, yes, it's still too high, but it has been trending lower. And the bank itself, as well as markets, are expecting downside in inflation to accelerate over the next 2 quarters. Growth is looking anemic right now. I mean, you have to squint really to see any real upside here for growth. It's been looking pretty bad. And apart from that, the labor market recently has shown us quite a few signs of worry, right? We've been seeing upside momentum in the unemployment rate with wage numbers, not really wage numbers, employment numbers not really looking good at all. So you've got this weird situation right now where the short-term data has been looking pretty good, but your aggregate data, like your inflation, your growth, your unemployment, those things have been looking pretty bad. That's why I think right now, when you look at what's pricing for the Bank of England, I do think that there's too few cuts priced for this. And the main reason for that isn't just the recent data that we've had, but remember, we had a very ugly budget being presented by the Chancellor last year, right? That was one of the main reasons why the pound suffered towards going into the budget last year, is because everybody was anticipating this really, really ugly budget show. And that hasn't changed, right? The markets are still pricing in a very bad growth outlook, still pricing in inflation to fall, still pricing in unemployment to trend higher over the next couple of months. So I'm a little bit perplexed on why the markets wouldn't be pricing in more cuts for the UK economy, given the budget risks that we have on the radar. So how does this feed into the Bank of England decision coming up this week? Well, firstly, this decision that we have coming up on Thursday will include the monetary policy report. Now, that is a quarterly report that we get from the bank, which is basically their way of telling us where they think the main things will be going. Where will growth be going? Where will inflation be going? Where will the unemployment rate be going? And as a result, where will interest rates be going? Now, I think the best chance that we have for a possible trade coming out of this is if we get a dovish leaning MPR from the bank. First thing that we'll need to look at is the vote split, right? In terms of how is the members currently voting. The expectations right now is that 7 of them vote for a hold and 2 of them vote for a cut. Now, the best case scenario for a possible short-term reaction in the pound after the recent upside that we've seen will be if we get a vote split that is looking a little bit more ugly, right? If we get a 5-4, meaning 5 people voted hold, but 4 people is on the bandwagon for a cut, that could see some initial weakness playing out for the pound, which could be interesting. But for any type of follow-through or sustainable move to the downside for the pound, what we would also need to see is we would need to see the monetary policy report from the bank painting a more bleak picture of the economy. If we see the bank coming out saying that, listen, as a result of the budget, we have a much bleaker outlook of growth, a much more sustained downside expectation for inflation, and an upside risk for unemployment over the course of the next few months, that should translate into the bank pushing their estimates for the bank rate lower, i.e. telling us that they think they're going to cut rates more. In my opinion, that is going to be the most attractive opportunity as short-term traders that we can look for some volatility. If we were to see that type of play, if we were to see that 5-4 vote split and the MPR shifting the bias to more potential cuts, the one pair that I do like on the back of that a possible outcome is the pound Kiwi. Now, we've spoken about the Kiwi already, so the bias there should be clear. In terms of the pound Kiwi, just like the pound Aussie, we've smashed through a couple of key levels of support. Momentum is very, very bearish at this stage. Now, the one thing, just like the pound Aussie, that I am a little bit concerned about, if we just quickly go to pound Kiwi, is again volatility, right? If you look at pound Kiwi, let's just bring that on the screen. Here we go. If you look at pound Kiwi, very similar situation to what we saw with the pound Aussie, right? Volatility has ramped to the upside after last week. Now, if we were to see markets calm down a little bit and volatility pushing lower a little bit, that just from a pure markets dynamics point of view, from a flow dynamic point of view, that could translate into some mean reversion to the upside for the pair. Now, what I'm hoping, selfishly hoping, is that throughout the week, as a result of that, we see the pair pushing up a little bit, seeing that mean reversion play out. And then when the Bank of England shows up on Thursday and they deliver a 5-4 and potentially, that bleaker outlook that we'll be looking for, that could potentially open up the door to add some to look for some downside risks then for the pound Kiwi. In terms of levels to aim for there, look, I think it's fairly obvious that key support right now is sitting at that 226. If that falls, we do have the cycle or prior low coming in at 226.26. Below that, just like the pound Aussie, there's quite a lot of downside that could be played out over the course of the next few weeks. Again, you're not expecting this to be a one-way train to the downside, right? These types of moves that we saw recently, that's not the norm. You are going to see some oscillation, obviously, but from a fundamental point of view, you would expect the bias to be tilted to the downside if the bank comes out with a slightly more dovish outlook. I think from a tradability point of view, that'll probably be the most attractive thing to look for. Apart from that, if we quickly take a look at retail positioning, this is also what I like about this pair. The markets have been crazy long this. So retail has been trying to buy the dip, as you would expect, and take a look at how long they are, this pair right now. That in itself, shows there's still a lot of downside risk. So that would be my preference going out of the Bank of England. Now, in terms of this week's US data, we've got a couple of big guns waiting for us this week. We've got the ISM manufacturing data coming up later on Monday. We've got the ISM services coming up on Thursday. We also have the ADP jobs data coming out. And then obviously on Friday, we get the real big guns in terms of the NFP. Now, there's a couple of things important to understand about this right now. The dollar is in a very precarious situation right now. Because if you take a look at the underlying data, right? If you look at what's happened to the dollar's obviously seen quite a lot of downside recently. This hasn't really been due to the economic data, right? The economic data for the US has been rather solid. If we go to the data quickly, you have a situation, look at the City Economic Surprise Index for the US. It's been absolutely ripping to the upside. That means that economic data has been surprising to the upside in the aggregate by a huge margin over the course of the last few weeks. If you look at those key metrics that we always look at, inflation is still way above target. Growth is looking absolutely solid. And the unemployment rate has recently ticked down to 4.1%. That is why, if you take a look at central bank expectations, that is why the Fed last week came out saying that, listen, we need to be cautious. We are in no rush right now to cut rates. We need to give ourselves some time. The economic data allows us time to be patient. We don't have to be in any rush right now to jump in to cut rates. So if you just look at the economic data itself, right, just looking at this itself, there should have been more upside momentum for the likes of the US dollar. The only reason really why we haven't seen upside is due to policy, right? Obviously, in the short term, talking back to the last week, we had that intervention scare coming out from Japan. That has obviously been one of the key triggers for more dollar downside. But apart from that, you've got foreign policy, which is still massively damaging for the US. It seems like every single week, the Trump administration is picking a fight with somebody, right? And that isn't good for the dollar. From a bias point of view. The other thing is we had that whole situation playing out with central bank independence under threat, where the expectation was that Trump was going to pick somebody that would be very, very dovish, pushing the Fed to potentially cut rates a lot more than they would normally have. And that was one of the key drivers to the downside. Now, what happened last week, we had some interesting data or news coming out that Kevin Warsh is going to be the new Fed chair, right? Now, if you don't know Kevin Warsh, he was a governor back in 2006 to 2011. Back then, he was a very hawkish central banker, right? He preferred hiking rates. He preferred to cutting rates sooner. He preferred not doing quantitative easing, cutting the balance sheet sooner. He was a policy hawk. Now, more recently, we've seen a slightly different Kevin Warsh, right? He's come out a lot more dovish recently, saying that he believes that the Fed needs to cut rates. He's also been very critical of how the Fed handled the inflation scare back in 2022 or back in 2022. So there's expectations that the markets got a little bit unsure or uncertain last week, saying that, but what type of who will we be seeing as the Fed chair? Will it be the Kevin Warsh that we knew from 15 years back? Or will it be this new one who's suddenly more dovish, more inclined to cut rates? Which one will we be seeing? And that's why we saw a little bit of relief playing out for the US dollar. Now, it's important here to understand that even though Kevin Walsh, the news is positive at the margin for the dollar, it doesn't change foreign policy concerns, right? It does offer less risk about central bank independence, which obviously has helped the US dollar. But some of the recovery was also tied, I think, to precious metals, right? If you take a look at what happened to precious metals, we know that the dollar was very strongly inversely correlated to metals. So if metals have a meltdown, from a pure flow dynamic point of view, you would expect a bit of mean reversion playing out for the US dollar as well. So where does that leave us with the dollar going into the new week with all of these data we've got coming up? I think the data this week will be important, more important than it would have been before Kevin Walsh, because there's now less independence risk, right? When you have less independence risk, the data suddenly matters more. Because remember, the data has been solid. High inflation, lower unemployment, super solid growth. The data has been great. The reason why the dollar hasn't been great has all been down to foreign policy and obviously central bank independence concerns. So if you remove one of those things that cause downside, which is the independence fears, then obviously that can translate into a little bit of upside as a pure mean reversion play. So I think the data matters a lot more this week than it would have done without the Kevin Walsh news, right? That's the one thing that we need to play. So how can we potentially look to play this? I don't think we have to go too crazy in terms of how we play this strategically compared to like we would with the RBA. I think it's very simple. If we get exceptionally strong data this week, there's less need for cuts. That means potential upside for the US dollar. If the data comes in really, really bad this week, pushing back against the Fed's idea that everything is okay and the labor market is doing fine, more bad data means more need for cuts, means downside for the US dollar. I really think it should be that simple when we play the data this week. Now, what would consider good and bad data? As always, when we look at the calendar, we never ever just look at the forecast, right? We always want to consider the minimum and maximum expectations for these things as well. So, for example, for the manufacturing PMI, expectations is 48.5, but the minimum expectation is 47.9. So anything close or below that will be bad. Anything above 49.9, let's say 50, would be considered good, right? So obviously, when you look at things like PMIs, always look at that 50 level. The 50, anything below 50 shows us industry contraction. Above 50 shows us industry expansion. So anything above 50 should be positive. Anything below that minimum will be negative. Same story for the ADP. Same story for the services PMI. And more specifically, same story for the NFP data. Now, don't be a sucker when NFP data comes out. Yes, the NFP itself is always the headline number. It always creates the first bout of volatility. But the markets very quickly then shifts their attention to the unemployment rate, to the average earning month-over-month, average earning year-over-year. These four components makes up the jobs report, right? You have to consider all four of these things. And just like the other ones, anything that gets close to or below these numbers will be considered bad. Anything that gets close to or above these numbers will be considered good. Obviously, we'll be getting a lot of data that feeds into the jobs data throughout the week. We'll be getting the ISM manufacturing, the ISM services, the ADP. All of those things will feed into NFP expectations, meaning if all the data this week surprises to the downside, that 64 number is probably a little bit high. If all the data surprises to the upside, it means that 64 number is probably a little bit low. And that is what we call the whisper number. Your data adjusted forecast is what you would refer to as the whisper number. So that is something important to look out for later in the week. I will have more as the week progresses and as we go through the data. I will share more on that, just so that everybody is aware what we're talking about and how we expect that forecast to potentially be adjusted as the new data comes in. So very, very simple. If it's super, super good data, we'll be looking for obviously upside risk for the US dollar, more so than we would have done before the Walsh news. And if it's really bad data, we'll be looking for downside. Now, how can we potentially look to express that? Again, I like the Kiwi right now from a fundamental point of view, from a rates point of view. If you take a look at where we're trading right now, we're at some pretty interesting levels of resistance. We pushed right into that 60-80 resistance level. Currently, we have seen some pullback, but the markets are very reluctant on trying to push this thing lower. So if we were to see some really ugly data, I'll obviously be looking for a possible breakout of that 60-80 level. In terms of how far I would allow that to run, I mean, I'll be looking at those psychological levels as always, 6150, the 62 is miles away though. We've got some interesting resistance coming up around the 62.10-ish, so that could be interesting to watch as well. And the other one that could be interesting, I got out of this at the open, out of my remaining dollar yen. We did well on the push to the downside, managed to take some profit on the move lower. I still think this is a risk of intervention, right? If we were to see the data coming in really, really bad, I'll probably look to rotate into some downside for the dollar yen as well, and looking to target these recent lows around that 152. What if the data comes in exceptionally good? What can we look to trade? Well, if we do see some buy the rumor, sell the fact reactions playing out for the Aussie, or if the bank does follow through with a possible hold this week, then Aussie US dollar downside is an obvious one we can look for. I think the pair is trading at some fairly lofty levels here. It wouldn't be a big stretch for us to trade back down towards that 68 mark. If we were to see them holding, we could potentially even drift back down towards 67. If the Aussie is on the back foot as a result of the RBA, and we then get good US data, we could potentially just look to use that as an opportunity to push or to look for downside risk playing out throughout the week for the Aussie dollar. There's a couple of key levels we need to watch, and I think that will be one that I would be most interested in to look for some expression of downside. Now, apart from that, the other risk that we just need to keep on the radar for this week is obviously earnings. Last week had some interesting reactions playing out for Microsoft. I'm not sure how many of you track that, but Microsoft, lots of downside. Down 10%, 5% after earnings, then down 10, and we've basically stayed down in that area. It's been ugly. The main reason for the downside look, earnings didn't collapse. Earnings actually came in pretty solid. The main reason why we saw that downside for Microsoft is because investors, there's a key theme that they'll be watching this year, and that is that, okay, you've made, all of these big tech companies have made these exorbitant investments into AI, massive amounts of AI investment. And what investors are asking them this year with earnings is that, okay, we've given you the benefit of the doubt last year. You've told us you're going to spend all of this money on AI. What do you have to show for it, right? What are you showing us in terms of returns? What is my return on investment for all of this money that you have invested into AI? And right now, looking at Microsoft, the markets went like, that wasn't good enough, mate. You have to do a little bit better. So that will be a key focus point coming into the week ahead. We've got key big earnings coming up for the likes of both Google, as well as Amazon. That'll be important, right? The weightings in these things massive. 6% weighting for Google in the S&P, 10% weighting for it in the NASDAQ. For Amazon, it's almost 4% in the S&P, over 6% for the NASDAQ, and you've got 3% there for the Dow as well. So big moves in those single names can definitely impact the broader indexes, and that's exactly what we saw last week. You know, if you take a look at what we traded, everybody blamed poor Kevin Walsh. Everybody blamed him for the move to the downside. But everybody conveniently forgot that the main reason for the push lower in the first place was Microsoft earnings. It had nothing to do with Kevin Walsh. But anyway, that's just me ranting on about how bad some of these reporting are these days. But anyway, so downside in tech, definitely going to be a key focus. So we'll need to, hopefully, for the likes of Google as well as Amazon, they could convince markets that the money spent was well spent. If we take a quick look at, let me just change the vol here to Google. We just quickly take a look at where we are on the week. Where's Google? There we go. If we take a look at Google on the week, not too excessive, to be honest. We've got implied vol low for the week coming up at 32.1, which is the low going back to the 22nd, and we've got a possible extension higher to 353. That's on a 1 standard deviation range, though. So keep that in mind. Those will be key levels to watch from an options point of view this week. So key earnings, Google as well as Amazon will be key, and obviously watching for possible further developments on the AI capex theme. Now, the other risk that we need to just be wary of, especially for the US dollar this week, is the potential of another US government shutdown, right? So we actually went into a shutdown again over the weekend, but the markets have been very calm about this so far today, because if you look at all of the political analysts right now, the vast majority of them believe that it's very, very possible for the Senate to approve the extension that they handed them back on Friday. So the markets don't expect the shutdown to continue. If, for whatever bad reason, the shutdown actually does continue and we don't see the Senate passing this thing, it's going to be, the brown stuff is going to hit the fan, right? It's not going to be great. The markets will possibly push the dollar lower on the back of that, because then the question will become, okay, when are we going to get the data? Are we even going to get the US data scheduled for this week? Remember back last year, we had weeks and weeks and weeks where we didn't get key US economic data. It was very frustrating for me as a risk event trader, and obviously as a macro analyst. It was just like, okay, well, we're flying blind. We don't know what's going to happen, what's happening in the economy. So watch out for the shutdown. For now, it doesn't look like a risk. They think that it should be easy for them to get that solved and across the board. But if they don't, obviously that could open up some potential downside risk for the US dollar as well. All right, guys. So let's quickly pop into the questions. I'll take them from top down. Let's quickly take a look. Yeah. All right. The first one, can you explain implied volatility in more detail? Yeah. So look, when you look at implied vol, in a nutshell, implied volatility is just it's the options market's estimate for how volatile an asset will be trading. Right. So it is unlike historical volatility, which tracks the actual volatility of an asset, or realized vol, as we call it. Implied volatility is the options market saying that, okay, based on what's happened and based on potential risks that we see on the horizon, we think this is what volatility could be for this asset. So it's not, you can actually trade this. It's tradable in terms of volatility. And obviously when you look at it like this, you will be like, oh, you should just sell vol when it gets crazy, but it's never that easy, right? But so when you look at something like a 37 implied vol, what that is telling you is that's always an annualized number. So this is the 1 month implied vol, telling us based on a 1 month snapshot of options pricing, the markets are associating a 37% price variance, or VAR, if you will, for gold over the next year, meaning that we think it could be either 37% higher than we are now or 37% lower than we are now over the next year. And then obviously you can extrapolate that into a daily range, a weekly range, a monthly range, as we normally do. So in a nutshell, that is what implied volatility is. All right, we've got a quick answer here, a question here from Paul. Talk about the yen at the end. Fantastic. So in terms of the yen, we've been obviously looking for downside risk for yen pairs or upside risk for the yen on intervention threats. Now, over the weekend, the PM of Japan, Takeishi, she's obviously under pressure, and I don't understand why these people do it. Over the weekend, she came out talking up the weakness of the yen. I mean, when you have your finance minister coming out, talking about the risks of a weak yen, you've got your central banker talking about the risks of a weak yen, and then US PM saying, well, you know what, a weak yen's actually, it's not that bad, right? It's doing good for export. So, everybody says it's bad, but I think it's actually quite okay. I'm like, what the hell? Why would you say that? Like, why would you say that? So that's why the yen is gapped to the downside at the open, is because of her comments over the weekend. Just absolutely silly when you are dealing with this type of currency problems that they are. But that is Japan for you. I mean, if you think the PM is bad, the central bank is even worse in terms of their communication, right? Don't get me started with them. I'll keep you busy for an hour just ranting about how bad they are. But in terms of the risk for this week, look, I still think that intervention risk is real, because we haven't really deviated that much away from the prior levels that got them excited. We had the potential threats of that coordinated intervention. That was Besson basically threw cold water on that. So I don't think that is a big risk anymore. What we have now, though, is we've got the dollar gaining a bit of strength. We've got obviously PM coming out talking up the weakness. I wouldn't be getting into this now again after getting out of it at the open. Let's see what happens with the US data, right? The US data this week is a key risk for intervention, because previously the bank has intervened both when we had good US data and bad US data. right? So when good US data came out and it pushed dollar yen higher, they used that as the trigger to push it lower. When they had bad US data, I think it was a CPI where that happened. When the dollar yen pushed lower, they used that momentum to do intervention as well. So I still think there's a risk of it, but I'm far less. I don't want to be holding dollar yen shorts in with that open risk. I would rather take it as it comes throughout the week, because with those comments from the PM, it just makes no sense right now to continue looking for that until we start seeing some price action that confirms it. A quick question here from Bazat. When is the deadline for the shutdown? The deadline is today, actually. So they only have today to pass it. So we are already in the shutdown, which is what makes it tricky. But the markets isn't really taking it serious right now, because every political analyst out there believes that the Senate, it won't be too big of a push for the Senate to push it through later today. Quick question here from Pacendo. Interesting one. Is there any fear of the dollar losing its reserve currency status? If so, as traders, should we be concerned? Big question, this one. Look, recently, there's definitely been a shift away from dollar focus, right? Especially if you take a look at what central banks have been doing in terms of gold. The reason why they've been, especially China, why they've been buying such a huge amount of gold is exactly that. They want to diversify away from dollar risk. More so on the geopolitical side, because remember, they're looking at Russia as an example, saying that, okay, Russia invaded Ukraine. The West basically laid claims on all of those assets that they have. They froze those assets. And other nations are like, well, I don't want that to happen to me. I'll rather sell those assets and just diversify into gold, which makes a lot of sense for them. In terms of reserve currency status, what makes it tricky is that maybe someday, right, it would be possible for the world to do that. But the amount of massive structural shifts that needs to take place for it to lose its reserve status is massive, right? Think about this. About 45% to 55% of international debt is dollar denominated. What happens to the debt if the dollar is no longer reserve currency? Right, there's a lot of debt that needs to be repaid. There's a lot of debt that needs to be shifted and transferred for that to even be close to a realization. There's also a lot of trade that's happening in the US dollar globally, right? Yeah, some of those trade has now started to be shifted more from to international currencies. But when you've got oil priced in the thing that is the reserve currency, it's very difficult to just get rid of the US dollar. You've got lots of countries in the world uses the dollar as their local currency, right? So it's so integrated. It makes it very difficult for that thing to lose its reserve status. Apart from that, treasury holdings across the world, equity holdings of US equities across the world, the dollar is the world is so invested in the US dollar. It will be very difficult for the dollar to lose its reserve status. Maybe down the line, eventually it could be possible, but the type of structural shifts that would be required to do that makes it, I think, untenable right now. A quick one from Prasindo again. Is the US debt a risk for the markets? Absolutely. We're now at a stage where the debt, I think the interest paid on debt is more than 50% of GDP, which is just scary. Look, the markets will continue to remain cautious about debt. I think it's something that we were able to brush off for many, many years as traders. But whenever we're going to take a look at what happened to the pound last year with the whole fiscal crisis, right? So I think fiscal sustainability is something that, as an ongoing theme, will be very important for us to watch as markets. Whenever the markets get a bit of a rattle about, fiscal sustainability, whether that is due to bad bond auctions or whether it's due to concerns about excessive spending, like we've seen in Japan as well, the markets are going to punish those currencies if we have those types of scares. And you should also see that playing out in the bond market as well, where you would normally, if yields move higher, normally that is a positive for your currency, right? So if you let's take a look at Japan, for example, normally this type of move in the yield should be positive for your currency. The reason why it's not positive is because you get good moves up for yields and bad moves up for yields. Right now, yields are moving up in Japan, not because of better economic data or expectations of higher interest rates or any of those things, yields are going up because the markets are saying, wow, we need to price in a risk premium for the massive amount of debt that you would have to make as a country to live up to your fiscal spending plans. The markets are saying it's not sustainable. It's the same thing that happened to the pound earlier, so last year. And obviously with the mini budget fiasco, for those of you who remember it. So you get bad moves up for yields when you have fiscal concerns. And when those yields then rip, you tend to see the opposite happen for your currency. So absolutely, I think any type of fiscal sustainability issues will be a very key ongoing theme for us for currencies. And obviously for the associated bond market as well. Oh, fantastic question here from Pierre. How do we see the overall yuan macro data and the relation and impact to the Aussie? Interesting one, because normally we had such a close correlation to the Aussie dollar and China, right? Obviously because of trade, massive trade partner. Over 40% of exports goes to China alone. Recently, though, the correlation has broken down a little bit, right? We've seen both good and bad economic data coming out of China, which just has not moved the needle at all. And it doesn't mean that the correlation will stay broken forever, but at least right now, the markets aren't very focused on it in the short term. The markets have been more focused on the domestic story when it comes to the Aussie dollar, obviously focusing on the RBA and rate expectations, and obviously the big moves we've seen in commodities as well. As a commodity-linked currency, that has kind of now taken the place alongside the RBA as the main drivers. But if we were to see massive upside or downside surprises for economic data in China, at some stage it will matter. But more recently, looking at correlations over the last, I would say 3 to 6 months, it just hasn't been one of those core drivers that you would normally expect for the Aussie. All right, guys, I am going to take one more and then we'll have to move on. Abizat is asking, for the Kiwi and the CAD, are the jobs data important? Yes, absolutely. The only reason why I didn't touch on those is just due to timing. There was a lot to discuss with the other ones. For these ones, very, very simple. Obviously, for CAD data, if we are going to be in any type of CAD trades at the time, like Aussie CAD, for example, if the RBA comes out with a hawkish hike, the Canadian labor data will be critical. I would be preferring to trade it lower on a miss as opposed to trading it higher on a beat, just purely based on how the markets are positioned and based on the momentum that we've seen in the currency. For the Kiwi, similar, right? If we are in Aussie Kiwi, if we are in pound Kiwi, doesn't matter what we are trading. If that Kiwi labor data comes out incredibly bad, that's going to be a risk for us to watch for those pairs for sure. Right now, expectations for these are fairly solid. There's no big shifts in terms of prior. Obviously, I'm hoping selfishly for these things to surprise to the upside, to give us a bit of a boost for the Kiwi dollar. That upside surprise, if we get one, should also be enough to see the institutional players trim some of those shorts they've got running on the Kiwi right now, which has been quite excessive compared to interest rate expectations. They're still sitting way low. So they're holding pressure on their Kiwis, which is strange given the interest rate expectations. So that could see a nice little pop to the upside. But obviously, that does pose a downside risk for the Kiwi as well if it comes in very ugly. All right, guys, I see we've still got a couple of questions in the queue, but we have been going for an hour now, so I'm just a little bit cautious of time. Please make sure to pop your additional questions. Send it via Twitter, send it via YouTube. We will definitely make sure to get to those questions as well. But I want to thank you guys for joining us for the Fusion Markets Week Ahead webinar. I hope it's been instructive. Hope you guys have learned something. Hope you guys have a fantastic week ahead. As always, if there's any questions, doesn't matter what it is, feel free to reach out anytime and let me know. We will be watching these events with a keen eye this week. So have a great one, and I'll catch everybody again for the webinar next week. Thanks, guys, and take care.